Bond.
Investment.
Bond.
Just like James Bond, investment bonds are an international global asset class, alluring super investors and retail investors alike. Since the first official government bond issued in 1694 by William III to fund a war against France, bonds have evolved to become a staple of investment portfolios all over the world. Whether it's government bonds or corporate bonds, investors have flocked to this kind of investment in the past to provide them a safe haven, a protection against inflation, and an almost guaranteed return in a very uncertain world. Well, what about bonds in the 2020s, where we are today? In this video, I'm going to look through and explain what bonds are, look at some of the pros, look at some of the cons, and then at the end, I'll give you my opinion on what I think.
He always did have an inflated opinion of himself.
Bonds in the finance world are very different from the land of the international super spy. A bond, very simply, is something that is formed as soon as you lend your hard-earned money to either a government or a company. And in return for your hard-earned money, that government or that set of companies will pay you a small amount of interest, paid as coupons, over the whole length of that bond. And that could be a year, that could be less than a few months, that could even be up to 10 plus years. Pretty much like lending money to your brothers or sisters for sweets, but in fact this time you'd probably more likely to get it back. Over in the US, they'll be called treasury bonds if you buy them from the government, and over here in the UK, they'll be called gilts, so look out for those terms. Very similar to the way that you and I as individuals have a credit score, governments and companies will have their own credit score, and depending on how creditworthy they are, or how likely they are to actually repay your money, they'll be given a different credit rating, and you'll typically hear phrases like a AAA or AA, for example, and they run all the way down to junk bonds. Typically, most people like you or I or different institutions will only really be invested in investment grade bonds, which are going to be those higher grade ones, more likely to be paid back. But you're also very much welcome to go down to the lower part of the market in the junk bond section. Junk bonds are like the Dogecoin of the financial world, so if you want to go ahead and put your life savings into them, yeah, I'm sure some people will become millionaires, but be prepared for a very risky and very bumpy ride. I'd stay away from them if I were you. Bonds have been used historically to balance out investment portfolios and provide stability when the stock market has been quite volatile. Over the long run, bonds have returned less than the stock market has, but they've also been a lot less volatile. If you can't stomach a 30% drop in the stock market, then bonds might be something to help you out. You can buy bonds in all kinds of flavors in all different places. I'll leave this bit up to you, but have a look at whatever your favorite investment broker platform is, search for bonds, and you'll see everything from different bond funds, government bonds, corporate bonds, you name it. Just make sure you do all of your own research so you know what you're getting yourself in for. Some of the world's greatest investors have been huge fans of holding bonds in a well-balanced investment portfolio. John Bogle, the founder of Vanguard, swore by a 60-40 split in his portfolio. That's 60% in stocks and 40% in bonds, and he didn't do too badly at all. He averaged a growth rate of 9.2% since 1989 using that 60-40 split. That's not too shabby at all. If you're interested in following John Bogle's advice, then I did a video recently talking about Vanguard's life strategy funds, which are a complete spectrum of mix between different amounts of stocks and different amounts of bonds, which could be a really nice set and forget investment for you if that's what you're looking for. So check that video out after this one. If we look back at all the years in the stock market from 1926, we'll see that stocks have returned on average around 8 to 10%, where bonds have returned on average 4 to 6%. Amazingly, throughout that entire period, there's only been one time where you've had a double-digit loss investing in a treasury bond. So bonds will certainly be the way to go if you struggle to sleep at night worrying about a 5-10% dip in the market, let alone a 30, 40 or 50% what we've seen historically in the past, compared to bonds, which have pretty much weathered the storms and stayed pretty much strong and stable. As I mentioned previously, bonds can be great stabilizers for a portfolio. Just look at this chart looking at the worst performing days in the market versus the worst years for treasury bonds. See the worst day in the S&P 500 where it lost nearly 20% of its value versus the worst year in the bond market, that's an entire year, where it lost only 11%. As we know, us investors feel losses twice as hard as we feel those gains, even if they are on paper, so just bear that in mind. And finally, bonds offer a lot more assurance. It's all great looking at these fantastic growth stocks and other amazing companies which we hope will do well in the future, but really we've got nothing else to go on. We can look at the fundamentals of the company and we can hope and pray that they continue to do really well, but really only bonds can give you that ultimate stability in theory where you're nearly going to get a guaranteed payout, and even if the rates are really super low, at least you know that's what you're going to get. So now let's look at some of the downsides because there's quite a lot in the 2020s we need to look at. Without fail, over the long term, if you are a true long-term investor with a minimum timescale of 5 years and maybe even looking into 30-year plus as your time horizons, then stocks have beaten bonds at every step of the way. So although bonds might help you sleep at night and reduce your volatility in the market and help you reduce those paper losses, ultimately as well, they eat away at those top end gains. So you might not get those real high end returns from the market when it's doing well, but you'll protect yourself on the bottom end. So really it's up to you, but in the long run, you're not going to get much else. Right now, we've got to consider that we're operating in an economy with a super low interest rate, which is set to not really go anywhere anytime soon. If you look at the treasury rates in the US and the gilts from the UK, they're really at terrible, terrible all-time lows. And then of course, in some countries, the rates are even negative. So you're charged money for keeping your money in the bank. So as an investor, rather than be rewarded for saving your money, you're actually costing you money. Some of the better rates in bonds also require you to lock your money away from really, really long periods of time. Think of those US Treasury bonds, for example, where you might have to lock away your money for 3 years, 5 years, or 10 years. And just think of all the opportunities that you might have lost during that time, whether it's saving up for a real estate opportunity, or what about you see a bargain on the stock market, but your money's already been locked away. And you can't get that money back once it's locked up into a bond. And if it's only going to just about beat inflation, then bit of a poor investment. Right now, I think you'd agree that there's far more opportunities in the stock market and around the world that investors can plough their money into rather than old school bonds. So as long as your timescales allow for it, and I'm saying that's minimum of at least 5 years, bonds seem to be, at least in my opinion, a bit of a waste of time. If the bond yield you're being offered is lower than inflation, let's say around 2%, then you're pretty much just throwing your money away. And there can't be many investors out there who really want to just lose money every single year, can there? Well, I'm sure there's some. But truly between you and I think we can do better. Real estate investment trusts, high income funds, for example, dividend blue chip stocks. We've got a wealth of things to choose from out there. And with all those things mentioned, I've not even touched on cryptocurrency, another place you could potentially put your money and invest it into something a bit more stable and deflationary, like Bitcoin, for example. Hell, you could even move to gold if you wanted to. If cash is trash, then bonds are bust. Okay, let's wrap things up. We've just gone through the pros and cons. Now, what's my opinion? What do we think? Bonds are not quite what they used to be. Well, you could argue, of course, because a lot of people like Sean Connery a lot, but Pierce Brosnan, I think, was one of the originals for me. In the past, you might have been able to get some really nice inflation-beating results keeping your money in bonds, tied up, sleep well at night, knowing that you can get your 4, 5, 6%, and even some years double-digit returns. But certainly, until those times change, bonds seem like a pretty poor place to keep your money. Warren Buffett has recently slammed bonds. He's completely declared them dead, citing record low interest rates and even negative rates in some countries that we just discussed a minute ago. Looking back through history, if we want to backtest all of this, unfortunately, bonds have never beaten stocks, at least in the long runs. Sure, they've had their individual years where they've done really, really well and protected you from that volatility in the market, but over that long period of time that a true long-term investor should be looking at, they've never won. In my personal situation as a 32-year-old with hopefully some many, many more years ahead of me, I'm 100% equity and a bit of cryptocurrency as well. Bonds are not something personally that I'm going to be invested in anytime soon, unless those things change. And of course, we don't know what the future is going to be, but certainly history has already taught us that lesson. I've already lead-lined my stomach, ready for those 30, 40% drops or different market corrections that we're going to have in the future, knowing that on average, things will always go up. However, I could completely understand from another perspective, if I was slightly older, for example, nearing retirement or trying to protect my assets, I can certainly see the appeal for bonds in that short period of time. If there was a market correction next year, but I needed that money to live and pay my bills, then I would certainly see the advantage of some bond usage in a good balanced portfolio. Saying that, everything seems to come down to your personal level of risk, because really it's how much you can look at the stock market going up and down, and especially watch it going down and still be okay. Have you got that emergency fund set to the side? Are you okay weathering those long-term risks and those long-term ups and downs? Or do you need a bit more stability in your portfolio? Really, this one's up to you. So although I'll be staying away from bonds, and I imagine a lot of people will do too, let's not write them off just quite yet. If I can give you any kind of reassurance, remember that every single bear market in history has been followed by a bull market, which historically, of course, has led us to where we are today. As long as we trust that there'll be more good years than bad, and I'll certainly not be adding bonds to my portfolio anytime soon. Anyway, I hope you've enjoyed the video. Drop me a like if you have, subscribe for more, and I'll see you guys in the next one.
Play it again, son.